Most Australians have no idea where they actually sit in the income distribution, and that gap between perception and reality is costing them in ways they don't even realise. People earning $80,000 a year feel average, but they're out earning more than two-thirds of the entire country. People pulling in $150,000 still feel like they're struggling to get ahead. And the truth is, that feeling isn't completely wrong, but it's not coming from where most people think it's coming from. Today, we're going to settle this once and for all, with real numbers straight from the Australian Taxation Office. We're going to show you exactly what salary puts you in the top 10%, the top 5%, and the top 1% in Australia in 2026. What those incomes look like after tax, what kind of life they actually buy, and most importantly, why crossing each of these thresholds changes everything, not just in your bank account, but in the way the entire system works for you. Let's start with something that will probably surprise you. The average Australian taxable income, according to the ATO, sits at around $68,000 a year. But here's the thing. The average is actually a terrible measure of what Australians really earn, because a handful of people at the very top pull that number way up the median taxable income. The number right in the middle, where half of all Australians earn more and half earn less, sits between $53,000 and $55,000 a year. So if you're earning $55,000 right now, you are literally the most typical Australian taxpayer. You are the dead center of the distribution, and yet most people at that income feel behind. They feel like everyone else is doing better. They feel like the goalposts keep moving every time they get a raise. And that feeling has a name. It's called social comparison bias, and it's the single biggest reason Australians massively overestimate what their peers are earning. We don't compare ourselves to the full population of 14 million taxpayers. We compare ourselves to our immediate circle, to the people we went to school with, to our colleagues, to what we see on social media, and those reference groups are almost always skewed heavily upward. So, before we get into the numbers, let's do something important. Let's put the full picture in perspective. Out of roughly 16 million Australians who lodge a tax return, about half earn less than $55,000 a pound year. That's the reality of income distribution in this country. Nurses, teachers, retail workers, tradies, admin staff, millions of hard-working Australians are living and building lives on incomes that most of us assume are impossible to. I'll get by on understanding. This isn't about feeling superior to anyone, it's about understanding where the actual thresholds are so you can make smarter decisions about your income, your career, your investments, and your financial future. Now, let's talk about the number most people are thinking about when they use the phrase top 10%, because this is where a lot of Australians have a completely wrong idea of what that threshold actually is. To be in the top 10% of individual Australian income earners in 2026, you need a taxable income of approximately $133,000 a year. That's the threshold based on the most recent ATO. Taxation statistics adjusted for current wage growth, that $133,000 salary, puts you ahead of 90% of all Australian taxpayers, which, when you say it out loud, sounds extraordinary. But here's what it doesn't feel like in 2026 inches, Sydney, where the median house price is sitting above $1.2 million, a $133,000 income still makes buying a home without significant family assistance genuinely difficult. In Melbourne, it's only marginally better. In Brisbane and Perth, you've got more options, but the cost of living in those cities has been closing the gap faster than most people expected. So we need to understand what this income actually looks like in real life, not just the gross number. A taxable income of $133,000 in the 2025 to 2026 financial year gets taxed like this. Under the current ATO bracket structure, you pay nothing on the first $18,200. The tax-free threshold, then 16% on income between $18,200 and $45,000, then 30% on everything between $45,000 and $133,000, and then you add the 2% Medicare levy on top of your total income. When you run those numbers, your total tax, including Medicare levy, comes out to roughly $34,500, which leaves you with a take-home pay of around $98,500 a year, or about $3,790 per fortnight. Now, that is a genuinely solid income, and in most Australian cities outside of Sydney, it absolutely buys a comfortable lifestyle. You can rent a decent place on your own, save consistently, invest meaningfully, and still enjoy your weekends without stress. But here's something almost nobody talks about. At this income level, you start hitting tax friction points that catch a lot of people off guard. If you don't have private hospital cover and you earn above $101,000 as a single person, you're now paying the Medicare levy surcharge on top of your standard 2% Medicare levy. That's an extra 1% at minimum, so you're suddenly paying 3% on your total income just for Medicare. And that surcharge sits there quietly until you take out private cover, which for most people at this income level makes private health insurance the single most cost-effective financial decision they can make. Because the premium for basic hospital cover from around $30 to $50 a month is almost always less than what you're handing to the ATO every year through the surcharge. And if you've got a HECS debt, which a significant number of people at this income level do, the repayment kicks in at $67,000 in 2025 to 2026 at a 1% rate rising progressively with income at $133,000. Your mandatory HECS repayment rate is around 8% on top of your income tax, so the actual take-home number is lower than most people expect when they first hear $133,000 a year being described as top 10%, it still feels like it should be more, and that gap between expectation and reality is exactly why understanding the real after-tax numbers matters so much. Now, let's talk about what happens when you push past the top 10% threshold, because this is where the financial landscape starts to change in ways that are not always obvious. To sit in the top 5% of Australian income earners, you need a taxable income of approximately $180,000 a year based on ATO data and current income trends. That number is $180,000 before tax. And here's where it gets really interesting, because $180,000 doesn't sit neatly inside a single tax bracket. It crosses two of them. The 30% bracket covers income from $45,000 to $135,000, and then the 37% bracket kicks in on every dollar from $135,000 up to $190,000. So on that slice between $135,000 and $180,000, you're paying 37 cents in the dollar plus the 2%. Medicare levy bringing the effective marginal rate on that top slice to 39%. Run the full tax calculation on $180,000, and your total tax, including Medicare levy, comes to around $51,500, leaving a take-home of about $128,500 per year, or roughly $4,940 per fortnight. That's strong income by any measure. And at this level, life genuinely opens up in ways that weren't available below the threshold. You can rent well in any Australian city, save, aggressively invest into a meaningful portfolio, and have disposable income left over that can actually change your wealth trajectory. But here's where most people at the top 5% income level make a mistake that costs them hundreds of thousands of dollars over their working life. They upgrade their lifestyle in lockstep with every pay rise, bigger apartment, better car, private school fees, overseas holidays, multiple subscriptions, and before they know it, a $180,000 income is producing the same financial anxiety as a $60,000 income, just with more expensive problems. This is what financial planners call lifestyle inflation, and it's the single biggest silent killer of wealth building among high-income Australians. The research backs this up. Consistently high earners who fail to build real wealth almost always trace it back to the same pattern. Their spending always expands to meet their income and sometimes exceeds it. So, what does it actually take to be at $180,000 and build serious wealth? The answer is deceptively simple. You need to keep your lifestyle costs at a level you could sustain on $100,000 and deliberately direct the gap into income-producing assets, because at $180,000, every additional dollar you invest has leverage. It compounds inside superannuation at 15%, tax it compounds outside. Super and generates franking credits through Australian ETFs and dividend stocks, and it builds the gap between your active income and your passive income, which is ultimately the only number that matters when it comes to financial freedom. At this income level, making your money work harder than you work for, your money is genuinely achievable if you stay disciplined about not spending the gap. And there's another tool that becomes extremely powerful at the top 5% threshold that most people ignore, and it goes by the name of salary sacrifice into superannuation. The concessional contribution cap for 2025 to 2026 is $30,000 per year, including your employer's compulsory contributions at 12%. A salary of $180,000 means your employer is already putting in $21,600 in super, so you have roughly $8,400 of remaining concessional cap. You can salary sacrifice before the end of the financial year, and here's the magic of that move. Those $8,400 would have been taxed at your marginal rate of 37% if you took them as salary. But inside super, they're only taxed at 15%. That's a tax saving of roughly $1,840 in a single year for doing nothing more than directing money you were already planning to invest through a different vehicle. It's completely legal, it's built into the system, and based on the data, the vast majority of Australians at this income level are simply not taking full advantage of it. Now we need to talk about the top 1%, because this is where the real conversation gets complicated and where the gap between income and wealth becomes most visible and most misunderstood. To sit in the top 1% of individual Australian income earners in 2026, you need a taxable income of approximately $420,000 a year. That number comes directly from ATO taxation statistics, verified against current income distribution data. And it's a number that surprises most people, either because they expected it to be higher or because they expected it to feel more attainable than it actually is. Roughly £100. And 10,000 Australians out of over 16 million lodged returns sit at this level or above. That's less than 1% of the entire population. And when you think about what industries and professions generate those incomes, the picture becomes clearer. Specialist medical professionals, surgeons, cardiologists, anaesthetists, senior partners at law firms and accounting firms, C-suite executives at ASX, listed companies, high-billing commercial litigators, senior investment bankers, and some of the more successful small business owners and property investors are the cohort sitting at $420,000 and above. What does a $420,000 income look like after tax in Australia in 2026? Let's run the numbers properly. Using the current ATO bracket structure, you pay nothing on the first $18,200, 116% from $18,200 to $45,000, 30% from $45,000 to $135,000, 37% from $135,000 to $100,000, and $90,000 and 45% on everything above $190,000, plus your 2% Medicare levy on the total at $420,000. Your total tax burden, including Medicare, comes to approximately $162,000, which leaves a take-home pay of around $258,000 a year, or roughly $9,920 per fortnight. Now, $258,000 take-home sounds extraordinary, and it absolutely is. But here's the part that catches almost everyone at this income level off guard. For every additional dollar you earn above $1, 190,000, you keep just 53 cents, the government takes 47 cents in the dollar at that marginal rate. Which is why high-income Australians at this level pour enormous energy into legal tax minimization. Strategies that simply aren't available or relevant at lower income levels. Salary packaging, private company structures, family trusts, discretionary investment entities, transition to retirement strategies, and maximizing every possible legitimate deduction. Because at 47 cents in the marginal dollar, the difference between smart tax planning and no tax planning can be worth tens of thousands of dollars every single year. And here's what most people never understand about the top 1% in Australia. The income threshold is actually relatively modest compared to what you might expect, but the wealth threshold is dramatically different because most of the people in the top 1% of income are not the same people as the top 1% of wealth. The truly wealthy in Australia built their money not through salary, but through ownership, through equity in businesses, through property. Portfolios that span multiple assets, through investment portfolios that generate passive income through franking credits and capital gains. Someone earning $450,000 as a surgeon is technically in the top 1% by income, but their actual net worth might be far lower than a tradesperson who bought 3 properties in the 90s, let them compound for 30 years, and now earns a modest salary but has a balance sheet worth $3 million. Income and wealth are related, but they're not the same thing, and the people who understand that distinction are the ones who build financial freedom, rather than just a high gross salary. So let's bring this back to what it all means for you, because this is the question that actually matters. Wherever you sit in this distribution right now, there are 3 things that determine whether you build real wealth, and none of them is simply your gross income. The first is the gap between what you earn and what you spend, because it doesn't matter whether you're at the top 10% or the top 1% if every dollar that comes in goes straight back out again. The second is what you do with that gap, because a dollar invested in an index fund or a dividend-paying ASX stock or inside superannuation is a dollar that starts working for you instead of for someone else. And the third is time, because compound interest is indifferent to your salary. It doesn't care whether you earn $80,000 or $800,000, it only cares how long you let it run. Someone earning $85,000 a year, sitting at roughly the 75th percentile, who saves 20% of their take-home and invests it consistently into a diversified ETF portfolio, will almost certainly build more real wealth over 30 years than someone who earns $300,000 a year, spends $280,000, and invests the rest inconsistently in assets they don't understand. The income percentile you sit in today is not your destiny, it's just your starting position. What you do with the gap between what comes in and what goes out is the variable that determines where you end up. And one more thing worth sitting with before we finish. The reason most Australians overestimate what their peers earn isn't stupidity or jealousy, it's a genuine statistical bias. We spend our time in social environments that skew heavily toward higher incomes. If you went to university, you were surrounded by people who went into professional careers that tend toward higher incomes. If you live in a major capital city, you're surrounded by people with higher than average housing costs, which creates the illusion of higher than average incomes. If you scroll Instagram or LinkedIn, you see the highlight reel of your peers, not the reality. And all of that creates a reference point that makes a $65,000 income feel poor, even though statistically it's completely normal. Understanding this doesn't just help you feel better about your situation, it helps you make smarter decisions about your career, your next pay, negotiation, your investments, and your financial goals. Because once you know where you actually sit in the distribution, you stop chasing a moving target that doesn't reflect reality, and you start building a plan that's calibrated to where you actually are. If this video helped you see your income in a different light, smash that like button, it helps more Aussies find this content. And if you haven't subscribed yet, now is the time. Hit the bell so you don't miss the next one. Thanks for watching, and I'll see you in the next one.